This is an example of statement of cash flows using the indirect method. In order to do this, we need to have comparative balance sheet, current year income statement, plus some additional information provided about changes in our fixed assets and equity accounts. We begin by looking at our income statement. Our net income is our starting point. We have $38,000 net income that was computed using the accrual basis. What we want to do is convert that to a cash basis. First item that I'm seeing is depreciation expense. Depreciation expense is a non-cash expense. Therefore, we must add it back. If we were on a cash basis, we would not have recognized depreciation expense. The other items we could find on the income statement would be a non-operating loss or non-operating gain. We find that we do have both. Looking at the loss, we want to back it out. So we will add the non-operating loss. We have a gain on the retirement of notes. To back it out, we will subtract the non-operating gain. We're still going to recognize them, but they're going to be an investing activity or finance activity, and we don't want to count them twice. We're done with the income statement. These are the only items that we would pull off that. Now we're going to focus on the balance sheet. And we want to look at the changes in the accounts that are used in accruals and deferrals, our adjusting entries. But first, let's look and see that cash at the end of the year is $17,000, where it began at $12,000. So our change in cash of $5,000 is actually going to be our answer down here, $5,000. We don't do a statement of cash flows to find out how much cash changed. That's simply beginning and ending difference. What we want to see is why, if the net income is $38,000, why did our cash only go up $5,000? So we're going to look at those things that were accrued and those things that either did or did not involve cash. Looking at my current assets, I see that accounts receivable actually has increased $23,000. Merchandise inventory increased $14,000, and prepaid rent went down. When we have a decrease in a current asset, we're going to add that back. This means that we had some rent expense that we actually had paid in advance, so we didn't have to use cash this time because it was used last time. We also see an increase in the two accounts. So because the accounts receivable went up, we have to subtract that because that is sales that we did not collect. We also see that we purchased inventory. In order to purchase inventory, we would have debited the inventory and credited cash. So those two increases in current assets will be subtracted out. Now we look at our liabilities. In the liability section, we see that accounts payable went down. If the accounts payable went down, then that is because we paid the liability. If interest payable went down, that's because we paid some of the amount we owed. So these two decreases are going to subtract from my cash. That subtracted $6,000 in cash. We also see that taxes payable went up. That means that our tax expense was greater than the cash we paid for it. When we add these adjustments, we're going to see that the adjustments totaled $18,000. So had we been a cash basis person, we would have reported a net income of only $20,000. But that still doesn't solve why we only had $5,000 in cash. At this point, we could really pull apart the balance sheet to find out why the long-term assets, the long-term liabilities, and the equity changed. Or we have additional information provided. So the first item we see is that we purchased plant assets for $60,000 by issuing a $60,000 notes payable. There is no cash in that statement. Therefore, this would not be entered. This would be a note of non-cash investing and financing activities. The next thing we see is that we sold assets that cost $20,000 with a book value of $8,000. We sold them for $2,000 cash. The only important number there is that we sold them for $2,000. We're not going to worry about the loss because we're only looking for the cash, and that's why we added back the loss in the previous operating section. Then we see that we issued cash, 3,000 shares at $5 par for $15,000. So we received cash of $15,000 in the financing section. Financing is going to deal with debt, borrowing, and equity. Investing activities will deal with long-term assets. Then we see that we paid $18,000 to retire a note. It had a book value of $34,000, and that's where we got the gain. The key information that we have here is that we paid cash. So the cash that we paid to retire the bond is subtracted. Not going to worry about the gain because we took care of that with the operating activity. We're only looking for the cash. Finally, with our additional information, it says we declared and paid cash dividends. So we're going to subtract the cash. So we'll add up the investing activities. And we see it's only the $2,000. Then we would add up and I put this in the wrong box, we're going to add up the financing activities, and we see that we have used $17,000. So our net increase in cash that we were hoping to have as $5,000, let's double check. Operating activities gave us $20, investing gave us $2, but financing used $17. We have our $5,000. So our beginning cash balance was $12,000, and our ending cash balance, we're just doing a proof of it here, is indeed the $17,000. We're balanced. That's a complete cash flow statement. This right here would be notes attached to the statement saying that we had a non-cash investing and financing activity for $60,000.